mixed bag of corporate earnings reports and robust economic data squared off against each other, and ultimately that led to a lower close for the big indices in the US stock markets. Investors found themselves navigating through a complex landscape of corporate earnings, some companies exceeding expectations while others fell short, and that contributed to a sense of unpredictability in the trading session. Take a look at this report from Reuters.
Wall Street closed lower on Thursday, dragged down by tech and other mega-cap shares amid fresh signs the Federal Reserve could keep interest rates higher for longer. The Dow dropped about 0.75%, the S&P 500 shed nearly 1.2%, and the Nasdaq plunged 1.75%. The Nasdaq was weighed down by the Magnificent Seven group of momentum stocks in the face of murky earnings guidance and a high-rate environment.
The market is reflecting disillusionment.
George Ball is chairman of Sanders Morris Harris.
It's reflecting both disillusionment in the slow rate of growth in their revenues on the one hand, and some degree of realization that the nearly 25% increase in the Nasdaq, driven entirely by the Magnificent Seven, may have been overdone. So one dose of reality, one dose of disappointment, and that's what's driving the tech stocks and the market down today.
A swath of robust data on Thursday included a 4.9% quarterly annualized jump in third-quarter GDP, the strongest reading in nearly 2 years, feeding investor worries about restrictive Fed policy. Among individual movers, shares of Amazon rose more than 3% in extended trading after the e-commerce giant reported better-than-expected quarterly revenue. Meta Platforms beat third-quarter revenue and profit expectations, but said spending next year will exceed analysts' forecast and suggested the Israel-Hamas conflict could dampen fourth-quarter sales. Its shares fell more than 3.5%. From the Magnificent Seven to the Old Guard, IBM jumped nearly 5% following its consensus-beating quarterly report. And UPS lowered its revenue forecast for 2023, sending its shares down nearly 6%.
Keeping it with the U.S., it was the turn for U.S. to announce its growth data, and that data was a remarkable turn of events. It's been the consumers of the U.S. who emerged as the driving force behind the American economy in the third quarter. As the U.S. continues to navigate through economic challenges, it's the resilience and spending power of the American public that has proven instrumental in propelling the country's growth. This surge in consumer-driven economic activity not only underscores the fundamental strength of the American consumer, but also poses crucial questions about the trajectory of the U.S. economy. More in this Reuters report. Have a look.
The U.S. economy grew at its fastest pace in nearly 2 years in the third quarter, once again defying dire warnings of a recession. That's according to the Commerce Department's advance estimate on Thursday. Gross domestic product increased at an annualized rate of 4.9% last quarter, blowing past the 4.3% GDP estimate forecast by economists polled by Reuters. Robust consumer spending fueled growth amid a resilient labor market, with businesses restocking warehouses and store shelves to meet strong demand. Consumer spending accounts for more than 2/3 of U.S. economic activity. The economy was also spurred by a rebound in residential investment after 9 straight quarterly declines. While the strong GDP pace is likely not sustainable, it showcased the economy's stamina despite aggressive interest rate hikes from the Federal Reserve to tame inflation. But growth could slow in the fourth quarter due to several factors, including the United Auto Workers strikes and the resumption of student loan repayments for millions of Americans.
In a move closely watched by markets and analysts across the world and policymakers as well, the European Central Bank, or ECB, has opted to maintain its current interest rates. This decision comes against the backdrop of a stumbling European economy that's been plagued by a wide variety of challenges. And the latest move by the European Central Bank comes amidst concerns over the Eurozone's economic trajectory. So what does this mean for businesses, consumers and investors across Europe? This report tells you more.
The European Central Bank left interest rates unchanged on Thursday. The move ended an unprecedented run of 10 consecutive rate hikes and was expected by market watchers. The ECB has lifted rates by a combined 4.5 percentage points since July last year to try and calm runaway price growth. But the central bank hinted last month it would pause those hikes as record high borrowing costs are starting to work their way through the economy. Price pressures are finally easing and inflation has more than halved in a year, all while the economy has slowed so much that a recession could already be underway. ECB President Christine Lagarde.
Based on our current assessment, we consider that rates are at levels that, maintained for a sufficiently long duration, will make a substantial contribution to the timely return of inflation to our target. Our future decisions will ensure that the key ECB rates will be set at sufficiently restrictive levels for as long as necessary to ensure such a timely return.
The ECB signalled it plans a steady policy ahead. It said it would keep all options open but follow a data-dependent approach. By keeping rates unchanged, it could raise expectation the world's biggest central banks are likely done tightening policy. That could turn market focus to the challenging task of working out just how long rates need to stay at their current highs, and when a cut might come. Another complication is that rising energy costs could keep inflation under pressure just as growth falters. Added to that, the outlook for the economy appears to be increasingly concerning, with industry in recession and the labour market starting to soften, and it puts a so-called soft landing in jeopardy.
Taking it back from Europe to the US, Meta, a parent company of social media giants Facebook and Instagram, has released its third quarter earnings and the results are nothing short of impressive. Meta has not only bounced back from the recent challenges but has also soared past all expectations with a remarkable recovery in its advertising revenues. What does it mean for Meta and the tech industry as a whole? This report tells you more.
Facebook and Instagram parent Meta has seen its most profitable quarter in years. That was thanks to cost control and a recovery in digital advertising ahead of the holiday season. Revenue also soared past expectations. The 3 months to September rose 23% to over $34 billion, $500 million more than what analysts expected. CEO Mark Zuckerberg promised 2023 would be Meta's year of efficiency, and it appears to be paying off. Its earnings report on Wednesday showed expenses cut by a few $1 billion. Zuckerberg said in a conference call that it would push hiring needs on non-AI roles to next year and deprioritize any non-AI projects. The company has been scrambling to update its data centers after falling behind adopting AI-friendly hardware and software systems. Now Zuckerberg says artificial intelligence will be its biggest investment in 2024. Meta has shed 21,000 jobs since late last year, mostly non-engineering roles. It's been climbing back from a bruising 2022 when investors fled as the company poured billions into metaverse products and as ad money dried up after the pandemic. This past quarter, however, sales were boosted by advertisers banking on holiday season shopping sprees. Meta's ad views increased by 31% compared to last year's third quarter. Market research Insider Intelligence believes global digital ad spending to hit over $667 billion next year. It says Meta is on strong footing thanks to its effective execution and cost control.
And finally, we take you away from US and Europe to Japan, to its capital, Tokyo, a city known for its rich tapestry of tradition and technology. And it is once again embracing the spirit of innovation. In the recent years, personal mobility devices have taken center stage in the bustling streets of Tokyo, fundamentally altering the way people move and connect with their surroundings. This transformation is more than just a shift in transportation ways. It's a cultural evolution. This Reuters report tells you all about it.
어떻게 움직이고 있는 거예요?
체중이도. 하승의 체중.はい、すいません。
大バランスで移動しますから、それが使える方であれば。
You move it by shifting your core. So if you're able to do that, you can use this. We've made it so that regardless of whether you have a disability or not, everyone can take a ride.
Tokyo always ahead of the curve. Now, in a major diplomatic move, the United States of America has issued a strong warning to American businesses operating in the African nation of Uganda. And that's concerning the recent anti-LGBTQ legislation passed in Uganda. What are the potential economic and diplomatic ramifications of this advisory and the reactions it has sparked both domestically and abroad? Here's a Reuters report.
The United States has cited Uganda's new anti-LGBTQ law as it warned businesses of potential risks in the country. An advisory was issued by the US Departments of State, Labor, Health and Human Services and Commerce, as well as the US Agency for International Development. It said Uganda's Anti-Homosexuality Act further increases restrictions on human rights, as well as exacerbating issues regarding the respect for leases and employment contracts.
And the title settled.
Uganda's anti-LGBTQ law, enacted in May, is considered one of the harshest in the world. Punishments include life imprisonment and the death penalty. Firms and non-governmental organizations that knowingly promote LGBTQ activity can be hit with harsh fines. The law was condemned by Western governments and put at risk billions of dollars in foreign aid. The World Bank has said it will aim to ensure gay and transgender Ugandans are not discriminated against in its programs, before resuming new funding, which it halted in August. In June, the US State Department imposed visa restrictions on Ugandan officials over the legislation. The State Department has also updated its Uganda travel guidance for US citizens to highlight the risks. Rights groups say Uganda's law has unleashed a torrent of abuses against LGBTQ people.
And that's all we have time for in this edition of Global Business Report. Thank you so much for watching. This is Krishna Kumar signing off. Keep it with News 9 Live.
They picked my husband. He was tortured there for